Hey Bowtie Nation, Joseph Hogue here with a fan favorite on the channel, adding to our list of penny stocks to buy for under $1 a share. We're coming up on 3 years of penny stock investing with an average return of 56% on the portfolio and 3 stocks up more than 400% over that time. In fact, shares of Ryerson Holding, ticker RYI, are up over 700% since recommending them in April of 2020. In this video, I'll show you how to invest in penny stocks along with the penny stock screener and criteria I use to book that double-digit return. I'll then reveal 5 more penny stocks all under $1 a share with an average upside of 349% return to the average analyst price target. I'll be using the stock screener on stockcard.io. I'll leave a link to StockCard in the video description below. Click through and then go to portfolios in the top menu. You'll find the Bowtie Nation portfolio in the stock picks section. It's free to follow and you'll get email notifications whenever I buy or sell from the list. Don't forget to use the promo code Bowtie Nation, that's all one word in lowercase, for an exclusive discount beyond the free trial. We're getting started, but before we do, you know I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I want to get into that list of penny stocks, so I'll show you later how I found these, as well as how to invest in penny stocks, and some warning signs to watch for. Our first penny stock trading for under $1 a share is MariMed Inc., ticker MRMD, at just 72 cents a share. Now, MariMed operates a cultivation, production, and cannabis dispensaries in 5 states, with a strong position in the Northeast markets, including a leadership position in Delaware, where it operates one of just 4 cultivation sites and 2 of the 6 dispensaries. We've been looking more at cannabis stocks over the past few months, with shares selling off since last year's peak. The graph here shows the Alternative Harvest ETF, ticker MJ in red, now down to less than half of last year's share price. MariMed has sold off as well, down about 40% from $1.20 a share last year, but still up over 300% over the last 2 years. And while I don't think we see any kind of movement in those federal regulations this year, since it is an election year, the momentum is still there and the industry is growing. We could be less than a few years away from banking reform that will open up funding to the industry and federal decriminalization that would boost growth. MariMed is already posting massive growth, doubling revenue in each of the last 2 years to $121 million in sales last year and positive earnings per share. Management is targeting sales as high as $150 million this year for growth of 24% and $50 million in EBITDA earnings. The company reports over $26 million in balance sheet cash against just $22 million in long-term debt and capital leases. So a net positive cash position here, which would mean plenty of funding to continue that growth. The average analyst target is for the shares to get back up to that $1.20 high within the next year, which would be a 67% return on the current price. Our next penny stock is by far the lowest share price at under 4 cents a share, though it's actually one of the larger companies on the list at a market cap of $169 million. Sun Hydrogen Inc., ticker HYSR. Now, it's also probably the riskiest on the list since it is a developmental company with no real revenue. Sun Hydrogen is developing the technology to split water into its components, extracting that hydrogen for use as clean energy source and leaving behind only oxygen in the process. And the potential here is immense, with Goldman Sachs estimating the hydrogen generation market could reach $1 trillion by 2050. That is 650 million metric tons of demand from just 83 million in 2020, roughly a 7% annual growth demand for 30 years straight. The company does have about $56 million in cash set aside for funding, but again, this is still a risky play until they can start booking that actual revenue. There aren't any analysts covering the shares, so we don't have any price targets, but the stock did reach 21 cents a share last year before falling back down. We've still got 3 more penny stocks to watch, but I want to take you through the screener and the criteria I use to start our search, and not just so you can build your own list of penny stocks, but so you know what I'm looking for and why. We'll start with the stock screener here on StockCard, and you can toggle this to screen for stocks or ETFs. We'll check this box for stocks under $1 each, and at any time, you can just click apply to see how many stocks meet that criteria. That $1 stock price still leaves us with over 8,000 stocks, so we'll click edit and go back into the screener. So let's narrow our list further to stocks with high growth potential and a positive record of sales growth. Now, these first 2 criteria are at the very core of penny stock investing. You're trying to find those companies at the verge of becoming the next Apple or Amazon, those startup companies with high growth potential and that proof in growing sales. Next, I also want to filter only for those penny stocks with strong cash availability and a track record of positive earnings. That leaves us with a much more manageable list of 174 companies from which to research it and then narrow it down to the best stocks to buy. And those last two criteria are extremely important. One of the biggest reasons new companies fail is for lack of funding and not having enough cash to carry the business through that initial growth stage. So you want those companies with plenty of cash reserves. Now, I also wanted to narrow our list down here to only those with positive earnings, so the kind of quality growth stocks that aren't just trading on a hope that someday profits are going to turn positive. It's a distinction that we've been seeing playing out in the markets lately, where those growth stocks that have yet to post positive profits are just getting hammered, while the positive earnings ones are holding up a little better. Another cannabis company here with unrivaled brands, ticker UNRV, trading at just 19 cents a share and up big last week. Unrivaled is focused on creating a leadership position across the supply chain in California and Oregon, from cultivation to operations, retail, and delivery. Now, what I like about this is I think when we do finally see some progress on federal legislation, you're going to see a lot of consolidation in the cannabis space. Here, you're going to see national companies formed through buying up all those regional leaders, so that makes Unrivaled a great takeover target. The company has been booking massive revenue growth, up 667% in the most recent quarter on a few key acquisitions, and sales were up 175% to $40 million last year. It also turned net income positive last year, and management is targeting over $130 million in revenue this year, which would be growth of more than 200% on sales. Now, there aren't enough analysts covering the stock price just yet for a good target price, but if we can hit that target of $130 million in revenue this year, I could easily see these shares up to 54 cents each. Next on our penny stock list, Ryerson Holdings, ticker MARK, and this is one that's burned me in the past, but I still believe in it. Remark develops artificial intelligence solutions for businesses and developers, specifically in retail, workplace and food safety, and in the smart city vertical. For example, in retail, its AI technology can analyze customer behavior in real time from the moment they walk into the store, and then use that to inform management how to provide a better customer experience, as well as other data decisions they need to make. This is real megatrend investing right here, and Remark consistently wins awards for its software. With that rise of AI over the next decade, management is estimating a market size of over $90 billion. Revenue jumped 42% last year to $14.4 million, and this one is reporting positive earnings, so a quality growth stock, and trading for just 5.3 times on that price to sales basis. But I did tell you, I've been burned on this one in the past. Remark is actually the worst performer in that penny stock list, down 72% since last March. On the average analyst target of $3.75 a share, though, it would still be a 47% return on that previous price and 435% over the current price of 70 cents a share. We'll get back to that list, but a wise man once said, with great return comes great responsibility, or something like that. And there are a few things you need to watch out for in penny stock investing. Understand first that a lot of penny stocks trading for less than $1 are going to only be available on the OTC market. And that's the over-the-counter market, and the stocks on this exchange, they don't have the same financial reporting requirements you're going to find on the NASDAQ or the NYSE. And that's going to mean a lot of shoddy companies, and honestly, a lot of dog shit stocks. So you're going to have to do a lot of your own homework when it comes to these stocks, digging into the financial statements. You can find the financial reports on any company by searching on Google for the company name, then Investor Relations. Now, that's going to take you to the IR page on the website with official filings and other news on the company. And this is why I tend to be very selective in penny stock investing, only investing in those companies that are already profitable and have proven track records for sales growth. Because you're already taking that big risk investing in stocks this small. You want to stack the deck in your favor by narrowing this list as much as possible with a criteria that screens for only the best of the best. And once you've found those penny stocks you want to buy, when you've narrowed it down to the very short list of maybe even 2 or 3 of the best, then there's a very important strategy to investing in these. Nation, you cannot trade your penny stocks. I've seen too many investors buy into these, sell the winners too early after maybe 20 or 30% return, and then hold on to the losers all the way down. You've got to give your penny stocks time to grow. If you look back at that penny stock portfolio here on the channel, we've had some real dogs, losses of 60 and 70% on a few, but because we let those winners run to those triple-digit gains, the portfolio is able to average out to that solid return. And that's why I always recommend treating your penny stock portfolio like a venture capital investment. And this is the part of the market I worked in before private wealth management, and finding those startup companies with massive potential but Even the best analyst, you're going to pick some crap companies. So what you do here, you be selective, only investing in maybe 3 to 5 of the best penny stocks you can find each year. Then you hold your stocks for at least that 3 to 5 years. Give those companies time to grow into that potential. After a few years, you'll have a penny stock portfolio of 10 or 20 companies with a great average return. Ryerson Holdings, ticker WTRH, got a boost in the pandemic, but has since settled back down to about 32 cents a share and one of the smallest stocks at a $70 million market cap. Founded in 2013, the company runs an online ordering tech platform for local delivery with an average daily order volume of 33,000 last year on 1.7 million active users. Now, obviously, revenue has come down since that height of the pandemic, but Waiter is investing in technology to diversify itself away from just that pure delivery segment. An acquisition last August enabled it to facilitate payment solutions for restaurants, and it's expanding into that deliver anything category for same-day delivery. Now, revenue was down to $182 million last year versus $204 million in 2020, but basically just settling back down to that 2019 levels, and the company has a solid cash position of $60 million on the balance sheet to help it evolve into this new business. You see here the current ratio of 1.95 times, so cash assets nearly twice the current liabilities and no real funding problems. The average analyst price target here of $2 each would be a massive 545% return on the current share price, the highest on our list. Check out that 2022 portfolio on StockCard or click on the video to the right for the 5 Web 3.0 stocks that will dominate in this mega trend. 5 stocks that could change the future of the internet. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.